Alex, welcome to the show. Good to be speaking with you again.
Yeah, thanks so much. It's been a big year, I think, since we spoke about that long ago.
Yeah, it has been a little while. I'm curious to get a bit of an update on how things are going for you and hear what's happening at Thorny. But I wanted to start, first of all, just with a bit of background. You have some pretty interesting extracurricular activities. They include being a company director for Visi and Pratt. You're vice president of the Collingwood Football Club. Sit on the International Advisory Board for the MBA qualification. And you've even tried your hand as a movie producer. Could you tell me which out of these things has been the most valuable and interesting for you? And is there anything that you wouldn't do again?
Yes, look, I believe that you've got to have a full and eclectic life and active. And I also believe from different industries and different experiences, you're always learning and you can cross-pollinate from them. And that turns out to be valuable, not only in your life skills, but as it translates to business. So I used to be on the board of the Visi and Pratt companies when I was actively engaged, not anymore. And I've been on the board of the Zoos Victoria as well. Collingwood Football Club was a fabulous experience for me. I was a lifelong fan and got to work my way up to sort of standing on the beer cans as a little kid at the front fence and being shouted over to eventually becoming, I think, the longest serving vice president of the club. And in a sense, we engineered a turnaround in the early days when Collingwood was in a lot of trouble. That was challenging but fun, and just being around the players, and I'm a fan at the end of the day, was a pretty exciting experience for us. Football clubs are small but complicated businesses and always in the media. So fortunately, I had Eddie Maguire there at the helm when I was there, so I managed to avoid most of the media, but it was still a good learning experience. And the other, making the films was actually a pretty good fun. It was kind of an early adventure. It was a joint venture with Village Roadshow at the time, and supporting Australian films and initiative. Actually, but what I did realize that it's just like any other business. It's got its complications. It's a series of contracts. You've got to execute on the contracts. When you're actually standing around on the film set and you're not the star, you're just on the sideline, there's a lot of wasted time and a lot of repeated endeavors. So, you wonder about efficiencies and how to improve it. And I'm sure there's technology now that helps you a lot there. But you realize despite the bit of glamour, it's just another business, yet an exciting business from the outside, another business on the inside. So you have to be passionate about it, obviously, to continue.
Why don't you tell me about the origins of Thorny? Where did the name come from? Why did you decide to start it? And what were the early days like?
Well, I'd studied law and commerce in Melbourne, but was keen to head overseas, which I did, and eventually found myself in New York, not wanting to work as a lawyer and study again to get the qualifications there. I found myself on Wall Street with an investment house called Prudential Beige, and I was in the international department, which housed a lot of foreigners, which was quite stimulating to meet people from all over the world. And we had a broad introduction to the sort of financial markets and financial products. And I realized then that I wanted to be more on the buy side than the sell side, and was lucky enough to join up and co-open the office of Robert Holmes-A-Court, who was Australia's first billionaire and a kind of a genius investor who I was somewhat in awe of, but managed to learn a lot from him. And I guess getting involved in the investment world on the buy side, and we had a small team, so I was, even though junior member, I got exposed to a lot of different skills and opportunities. I think that whet my appetite to continue in the investment world, not go back to law to practice as a solicitor. And so when I did return to Australia, and after my 6 years in New York, I really wanted to find an entrepreneurial environment in my hometown which I did with Richard Pratt and the Visi Group. They were probably the most entrepreneurial industrial company in Australia, and perhaps still are one of the great Australian companies and success stories, now run by Anthony Pratt, Richard's son. But within that, I wanted to spread my own wings as well and continue not so much down the manufacturing path, even though they were doing great things, but to go into the investment world. And I realized that after seeing the energy and momentum and sort of aggressiveness and competitiveness of the New York markets and the US markets, that that kind of environment was lacking for the most part in Australia at the smaller end of the market. Sure, Holmes à Court was there, and other people like Alan Bond and obviously Rupert Murdoch at the bigger end, but in what I realized was in the micro cap space and in the small cap sector, there was not a lot going on. They were relatively unknown, sleepy companies. Sometimes they had board members who were just there as more like rubber stamps or filling in the numbers. And they were largely undiscovered, and I didn't have much capital to start with, but I wanted to be a thorn in the side, if you like, of those companies that were sleepy, and that was part of the origin of coming up with the name Thorny.
I've heard that there were quite a few years in the early days where you were producing returns of 100% or more per annum. First of all, is that right? And secondly, if so, how do you think you were achieving those kinds of returns?
Well, that is right. And as I said, I started off with a small amount of capital, just over $1 million. And in fact, in the first year, turned that $1 million into $4 million. And that was actually a fair bit of trading activity, and it was active times there. And I was, I guess, I was okay at it to achieve those results. But I wasn't really interested primarily in being a trader, although obviously we were good at it. I was more interested in building a stake or stakes in companies where I could engage with the management fundamentally, or the boards or the decision makers around the company, and be part of really what was making the company, the business tick. I was interested in the business, whether it was through a public company or through a private company for that matter. And so obviously with a small amount of money, I was focused on those micro caps and taking a position in those and engaging with the principals. For the most part, it was well received. Even though I was a young guy, people liked the fact that I'd spent a few years in New York. I'd had some experience through Visi, through understanding business organizations, and that was a pretty hardcore run business, and just talking to them about how to scale up and how to do things with a bigger picture in mind. Mainly I got pretty good responses, and trying to help them not only improve their capital structure, but actually the decision about how they expand and where they expand, getting better board members on board, introducing them to my few connections in the brokerage world and the investment houses to get behind them, achieved some 100% plus performances in those early years. So it was terrific, and it was really exciting, and I realized that I love the engagement in the variety of businesses. So I also decided I didn't want to become a super specialist. It didn't suit my personality, because generally I'm a sort of curious person, and as I said earlier, I think you can cross-pollinate from one business to another business and learn and improve. So I set myself the task of being a sort of a well-educated generalist, and then reach out to specialists as needed for the particular nuances of those business. But taking the general business skills, which maybe account for 80% of any business, we're able to adapt that from one to the other, and targeted a lot of the, as I said, they're very small companies, but somewhat exciting companies, or those that had hidden assets such as real estate in them. And then if you turned over the real estate or sold them, you realized that the NTA was actually triple what was the stated NTA was, because it hadn't been revalued for years, and suddenly the share price would explode on the upside because investors realized that there was a lot more worth in those companies, or selling off a division that was poorly operating. And those situations still occur today, what I would call orphan assets in businesses. I mean, recently, and top as an investor in ACM, the media group that myself and Anthony Catalano bought out of Fairfax just over 2 years ago. So that was a business at one stage that was valued, I think, at $4 or $5 billion. And, we paid just over $100 million for the assets. Obviously a declining newspaper audience, but still many assets in there. And in fact, we got a lot of real estate as part of the deal. And it was a business that had not had enough, I would say, love and attention and capital from the top down, but it was actually more of a funnel of its cash going up. So it was underinvested in, and we've managed to turn that around very nicely, despite bushfires and floods and the drought and obviously COVID. So the point is, and I found that still 20 or 30 years ago, and it still exists today, that there are many parts of businesses that are not focused on. And it's quite hard, particularly for founders, to sell off what might have been sort of family assets or icon assets in the group. But actually, if you encourage and explain the rationale and the financial integrity in terms of doing that on behalf of in a public company for shareholders, you can find superior performance comes out. And that's very much what happened in those early years. We found a lot of those type of companies.
You manage two different listed investment companies, TOP, Thorny Opportunities, and TEK, Thorny Technologies. Could you explain the difference between the two in terms of their investment strategy?
Yeah. Top is the older company, and it came very much out of a lot of what I just described there. It's looking for value, it's looking for fallen angels that may be candidates for a turnaround and improvement. It's looking for companies that may have those assets that can be sold off to liberate the balance sheet and focus management on the core business. Those type of value or turnaround or orphan asset situations was the main emphasis of that mandate, very much along the skills that we had within the Thorny group. And that's been where that series of endeavours have been focused on. It's got about 130, 140 million of assets there. It's a more concentrated kind of portfolio. And over the last couple of years, of course, the focus of investors very much been on the growth and disrupting tech world. So value has been somewhat forgotten. But I always believe value comes through at a certain point in time, and we keep working those assets. And we had a pretty good year last year. I think our NTA was, after fees and so on, was above 10% before a record dividend, and the share price, I think, moved about 15% to the upside. And we think there's a lot of unlocked potential in that portfolio, which we're working hard to achieve that over the next few years. So we need to explain that narrative a bit better, because relative to tech, it's been an underperformer, but in its own right, it's been okay.
Yeah, well, I was actually going to ask you what you thought was the reason for the diverging returns on those two, but I think you pretty well addressed it there. Do you have any plans?
Well, we also went through a few thematics there, and I think we were probably a little bit early. We've got some exposure in mining services and infrastructure services with companies like Austin, that if you look, you'll see a new CEO has just been installed there. Mermaid Marine, which has moved to clean up its shipping fleet, and rates are going up. Deckmill, which has recapitalized to deal with the problem in the balance sheet from two failed contracts or bad contracts. Southern Cross Electrical, good company, going well, not well known. I think we went a little bit early in that thematic, but we're pretty happy with the infrastructure spend that's going on, and the capital that's been raised in the mining sector or resources sector, that those companies are well positioned to take advantage of a lot of capital in the next period. So we're looking for those companies to perform. There has been a couple that we've got wrong that we're working through. One is Pala Pharmaceuticals, which is legalized opium to deal with for pain medication. That's been a bit of a journey, but it's one of the few companies left in the world that is fully licensed and has all the government protocols to operate in that space. So that's been streamlined. A lot of work is going on. Change of CEO is happening. So whilst it's been a long journey and we're down on our money, we haven't given up completely on that one. And there's a few in that category as well. Murray River Organics, food group out of Mildura, also has a new leadership team. And these turnarounds, they don't happen overnight. You have to stay with them. Sometimes you have to invest more capital to support the balance sheet on the journey. But as I said, some of our best successes at Thorny over our 30 years have come from these type of situations. Names that come to mind is Hub, the investment platform, mainly for superannuation funds and so on, which is a huge success now, 1.7 billion probably market cap. When we invested, it was maybe 20 or 30 or 40 million dollar market cap with bleeding money from divisions. Webjet, another company that was turned around. So we've been involved. Money3 itself, which I think I mentioned is the largest position, that had to change its dynamic, had some problems. So we're used to those situations. They don't always go in the direction and the time frame that you'd like, but I think for the most part they get there eventually. And so we'll stick with that thematic, and we think, as I said, there's a lot of potential, I believe, in the portfolio. That's why we've been conducting a buyback in top over the last year. But switching to tech, which people have become, I think, a bit more excited about, that's had a terrific year and focus in the broad technology space. Listed companies, pre-IPO, earlier stage, in the life cycle of a tech company, investing primarily in Australia, but growing over the last couple of years as well in the USA and out of Israel as well, where we have sort of strategic alliance partners. So the NTA of tech was up close to 50% for the year just passed, and the share price, I think, moved up around 70-odd% during the year. So tech is not a dividend payer, top is a dividend payer. And as I said, it's been exciting. And again, we've taken the view of we're not going to focus as a specialist on one particular sector or vertical within technology. We'll play a broader range within the thematics that we are confident in, such as fintech or agtech or medical sector with devices or diagnostics, logistics, things like that, that we do have some working knowledge and that we can get expertise in as we need it. So that's been a lot of fun, and we've had some excellent successes there. I wish to some extent that we had a bigger pool of capital and hadn't had to sell out some of the earlier positions to keep circulating money. And indeed, we just recently did a small capital raising of $25 or $26 million to boost the opportunities, because our pipeline and of deal flow is very strong, very robust.